Before we begin today's analysis, a brief word about this channel. If you value clear-headed thinking in financial markets, if you appreciate disciplined analysis over panic and hype, I invite you to subscribe. Subscribe button. Red. This channel exists to help you think better, not react faster. We focus on fundamentals, market structure, and the psychology that drives real opportunity. Now, let's examine something significant happening in the silver market. Whispers are circulating through commodity trading desks. Supply chain analysts are reviewing their models. Industrial buyers are quietly adjusting procurement strategies. And investors who've watched silver for years are paying closer attention than they have in a long time. The conversation? Potential supply disruption in the silver market, not speculation about price moonshots, not get-rich-quick fantasy, but structural questions about whether the physical supply of silver can continue meeting demand at current price levels. This matters. And it matters whether you own silver or not. Why? Because silver sits at the intersection of monetary history, industrial necessity, and investment strategy. When structural imbalances appear in markets like this, they create conditions that reshape asset allocation decisions across portfolios. Today, we're going to examine this situation the way serious investors should. Calmly, thoroughly, and with clear perspective on what it means for your capital. We'll look at the supply fundamentals. We'll examine the demand drivers. We'll explore what history teaches us about commodity supply shocks. And we'll discuss how to think about this, whether you're already positioned or considering entry. Let's begin with the reality check every investor needs. What exactly are we talking about when we discuss silver supply concerns? We're examining a convergence of factors that suggest the gap between silver production and silver consumption may be widening. We're looking at mining output trends, industrial demand acceleration, and inventory drawdowns that together paint a picture of tightening fundamentals. This isn't about one dramatic event. This is about structural shifts that accumulate slowly, then reveal themselves suddenly. Think about how markets work. For years, conditions can remain stable. Supply meets demand, prices fluctuate within ranges, inventories buffer the difference between production and consumption. But beneath the surface, changes occur. Ore grades decline. New mine development slows, industrial applications expand, investment demand shifts, inventory levels fall. Then, one day, the market realizes the buffer is gone. That's the conversation happening now in silver. Not certainty of crisis, but recognition that margin for error has narrowed considerably. Let's be precise about the data. Silver mining is not a simple business. Unlike many commodities, most silver doesn't come from primary silver mines. Approximately 70% of global silver production comes as a byproduct of mining other metals: zinc, lead, copper, and gold. What does this mean? It means silver supply doesn't respond to silver prices the way simple economics textbooks suggest. When silver prices rise, mining companies can't simply produce more silver. They're producing zinc or copper, and silver comes along for the ride. The decision to open or close a mine depends on the economics of the primary metal, not silver. This creates supply inelasticity that few investors understand. Global silver mine production has been essentially flat for the past decade. Some years it rises slightly, some years it falls, but the trend line is horizontal, not ascending. Why? Because the easy silver has been found. New discoveries are rare. Existing mines face declining ore grades, meaning they must process more rock to extract the same amount of silver. This increases costs, even as output stagnates. Meanwhile, secondary supply from recycling has its limits. Silver is consumed in thousands of small applications: electronics, solar panels, medical devices. Much of this silver is practically unrecoverable. Unlike gold, which largely sits in vaults and jewelry and can be recycled efficiently, silver gets used up. The recycling rate for silver is roughly 30%. That means 70% of silver used in industrial applications essentially vanishes from the supply chain. Add one more factor: above-ground inventories. For decades, visible silver stockpiles provided a buffer. When demand exceeded mine production, the market drew from inventories. These stocks, held in exchanges, warehouses, and government reserves, smoothed out the supply-demand balance. Those inventories have been declining, not catastrophically, but consistently. Year after year, more silver leaves storage than enters it. What happens when buffers disappear? Markets become fragile. Small disruptions create large impacts. This is the supply picture. Not a collapse, but a structure increasingly vulnerable to shock. Now consider the other side of the equation. Silver demand is not static. It's evolving in ways that create sustained structural pressure on supply. Start with industrial demand. Silver possesses unique properties: highest electrical conductivity of any element, highest thermal conductivity, superior reflectivity. These characteristics make it irreplaceable in many applications. The energy transition is silver intensive. Each solar panel contains approximately 20 grams of silver. As the world installs solar capacity to meet climate goals, silver demand from photovoltaics grows exponentially. In 2023, solar panel production consumed roughly 150 million ounces of silver. Projections suggest this could double by 2030 as solar installation accelerates globally. Electronics demand remains robust. Every smartphone, computer, and electric vehicle contains silver. As technology proliferates, particularly in developing economies, this baseline demand continues rising. Then there's investment demand, the variable that makes silver different from purely industrial metals. Silver has monetary history. For thousands of years, it served as money. It still carries that legacy in investor consciousness when confidence in paper currencies wavers. Some investors turn to physical silver as a store of value. This investment demand is episodic but powerful. In certain market environments, it overwhelms the physical market. We saw this in 2011, when silver briefly touched $50 per ounce. We saw it again in 2020, 2021, when inflation concerns drove investors toward hard assets. Here's what matters. Industrial demand provides a floor. It's consistent, price inelastic, and growing. Investment demand provides volatility. It comes in waves that stress the physical market's capacity to deliver metal. When both industrial and investment demand are strong simultaneously, the market faces pressure it struggles to accommodate. Are we entering such a period? That's the question traders are asking. History doesn't repeat, but it rhymes. What can past silver markets teach us? Consider 1979, 1980. Silver went from $6 to $50 in a matter of months. Many attribute this to the Hunt brothers' attempt to corner the market. That's part of the story, but it's not the complete story. The late 1970s featured high inflation, currency instability, and geopolitical tension. These conditions drove investment demand into precious metals. When the Hunts added their enormous purchases to already tight fundamentals, the market broke. The lesson isn't that dramatic price spikes are guaranteed. The lesson is that when fundamentals tighten, catalysts, whether manipulation, panic, or policy changes, can trigger outsized moves. Look at 2011. Silver rallied from $15 to $48 in roughly 8 months. Again, this wasn't random. It followed the 2008 financial crisis, occurred during quantitative easing, and coincided with concerns about sovereign debt in Europe. Investment demand surged. Physical dealers couldn't source inventory. Premiums on coins and bars exploded above spot prices. The market revealed how thin the line is between adequate supply and shortage. Then silver crashed, falling back to $26 within weeks. Why? Because investment demand is fickle. When momentum breaks, it reverses violently. The pattern is consistent. Long periods of range-bound behavior interrupted by explosive rallies followed by brutal corrections. What distinguishes a sustainable move from a speculative bubble? Underlying fundamentals. When silver spikes purely on investment mania, without supply-demand justification, crashes follow. When price rises reflect genuine structural tightness, moves tend to sustain longer and correct less severely. Today's situation resembles neither 1980 nor 2011 precisely, but elements echo both. We have inflation concerns, currency questions, and physical supply tightness. We don't yet have the speculative mania. That's actually important to note. Early in structural moves before the crowd arrives is when disciplined investors position. Once mania begins, risk overwhelms opportunity. Understanding where we are in the cycle matters enormously. How do we monitor whether supply concerns are real or exaggerated? Professional traders watch several indicators. You should too. First, exchange inventories. COMEX warehouses in New York hold registered silver available for delivery against futures contracts. These stocks fluctuate, but trends matter. Sustained drawdowns suggest physical demand exceeding supply. Growing inventories suggest the opposite. Second, premiums over spot price. When you buy physical silver coins or bars, you pay a premium above the quoted spot price. This premium reflects manufacturing, distribution, and, crucially, physical availability. In balanced markets, premiums are stable and modest. When physical metal becomes scarce, premiums explode. Spot price might say $25, but you might pay $30 for actual metal. That $5 premium tells you something important. The paper price and physical reality have diverged. Third, backwardation in futures markets. Normally, futures contracts for delivery months further out trade at higher prices than near-term contracts. This reflects storage costs and interest rates, what's called contango. When near-term contracts trade higher than distant contracts, backwardation, it suggests immediate physical demand is intense. It means the market wants metal now, not later. This is a classic supply shortage signal. Fourth, lease rates. Silver can be borrowed from holders who lease it to industrial users or traders. When silver becomes scarce, lease rates rise sharply. Monitoring these rates provides insight into physical tightness. Fifth, miner behavior. Are silver miners hedging their future production by selling forward? Or are they reducing hedges, betting on higher prices? Miner behavior often signals industry expectations about supply-demand balance. None of these indicators alone tells the complete story. Together, they create a picture. Are we seeing coordinated signals of tightness or isolated data points that could be noise? Currently, several of these indicators are flashing yellow, not red. Inventories are declining, but not yet critical. Premiums are elevated, but not extreme. The market is showing stress, not crisis. That distinction matters. It's the difference between pay attention and panic. We're firmly in the former category. Smart investors monitor these signals systematically, adjusting conviction as data accumulates. Silver doesn't trade in isolation. Its relationship with gold provides context every investor should understand. The gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, fluctuates significantly. Historically, this ratio has averaged around 50 to 60. Sometimes it compresses to 35 or 40. Sometimes it expands to 80 or even 100. What does this mean? When the ratio is high, say 90, silver is cheap relative to gold. And when it's low, say 40, silver is expensive relative to gold. This relationship matters because gold and silver respond to similar macro drivers but with different intensity. Both benefit from inflation concerns, currency weakness, and flight to safety flows. But silver, with its industrial component, also responds to economic growth expectations. This creates a useful framework. In stagflation, high inflation with weak growth, gold tends to outperform silver. In reflationary environments, improving growth plus inflation, silver often outperforms gold. Currently, the gold-silver ratio sits in the middle of its historical range. Not screaming, buy silver, but not suggesting it's overvalued either. For investors thinking about precious metals allocation, this ratio provides a tool. Some prefer to hold both metals, rebalancing between them as the ratio shifts. Others use the ratio to time entry into silver specifically. The key insight: silver is more volatile than gold. It amplifies moves in both directions. When precious metals rally, silver typically gains more percentage-wise. When they decline, silver usually falls harder. This volatility is a feature, not a bug, if you understand it. It means silver offers greater return potential for those willing to accept greater price swings. Risk and reward remain inseparable. Always. Let's zoom out. What's happening in the broader economy that could affect silver? We're living through a period of significant monetary transition. Decades of low interest rates and massive central bank balance sheet expansion created distortions. Now, authorities face the challenge of containing inflation without destroying growth. This is the tightrope walk. Raise rates too much, recession follows. Raise them too little, inflation becomes entrenched. For commodity markets, this environment creates cross-currents. Industrial demand depends on economic growth. Investment demand depends on inflation expectations and currency confidence. Silver sits at the intersection. If the economy strengthens, industrial demand supports prices. If inflation persists, investment demand adds fuel. The challenge comes if recession arrives while inflation remains elevated, stagflation. This scenario historically favors gold over silver, but doesn't eliminate silver's appeal. Supply tightness can overwhelm weak demand, especially if investment flows seek inflation hedges. Geopolitical factors matter too. Trade tensions, resource nationalism, and strategic stockpiling could all affect silver markets. If governments decide silver is strategically important, which its role in green energy suggests, policy interventions could reshape supply-demand dynamics. Currency markets provide another lens. Silver, like gold, often moves inversely to the US dollar. When the dollar weakens, commodity prices typically rise in dollar terms. When the dollar strengthens, prices face headwinds. Current dollar trajectory remains uncertain. Competing forces, U.S. interest rate policy, fiscal concerns, and international reserve diversification pull in different directions. For silver investors, the macro backdrop is complex but not incomprehensible. The key is recognizing that multiple scenarios could unfold. Positioning should account for this uncertainty, not bet on a single outcome. Flexibility beats dogmatism. Always. If you already own silver, what should you be thinking about right now? First, understand your original investment thesis. Why did you buy silver? Was it inflation protection, portfolio diversification, speculation on price appreciation, industrial demand growth? Revisiting your rationale helps you evaluate whether current conditions reinforce or contradict your original thinking. If supply concerns materialize and prices rise substantially, what's your plan? This is crucial. Many investors fantasize about gains but have no exit strategy. They ride prices up, then ride them back down, achieving nothing. Consider scaling. You don't need to be all in or all out. You can take partial profits at predetermined levels, reducing risk while maintaining exposure. This approach removes emotion from decision-making. For example, if silver rises 30% from your entry, you might sell 1/3, locking in gains. If it rises 60%, you sell another third. This ensures you benefit from strength while protecting against reversals. The key word is discipline. Decide your framework now before emotion clouds judgment. Second, Think about allocation sizing. How much of your portfolio is silver? Is it appropriate given your goals, timeline, and risk tolerance? A common mistake is allowing a single position to dominate portfolio risk. Even if you're bullish on silver, concentration creates fragility. If you're wrong, or if timing proves poor, an oversized position creates painful losses. Generally, hard assets like silver should represent a minority of most portfolios, perhaps 5 to 15% depending on individual circumstances. This size provides meaningful exposure without creating existential portfolio risk. If silver has appreciated significantly and now represents a larger share than intended, rebalancing deserves consideration. Taking some profit to restore balance isn't missing out, it's risk management. Third, consider the form of your silver holding. Physical coins and bars, ETFs, mining stocks, each carries different characteristics. Physical metal provides tangible ownership and removes counterparty risk, but involves storage concerns and lower liquidity. ETFs offer convenience and liquidity, but introduce structural risks and management fees. Mining stocks provide leverage to silver prices, but add equity market risk and company-specific factors. Diversifying across forms can optimize the risk-reward profile. Some physical for security, some ETF exposure for liquidity, perhaps some minor exposure for growth potential. Finally, prepare emotionally for volatility. Silver can swing 10 or 20% in a matter of weeks. These moves test conviction. If you haven't mentally prepared for volatility, you'll make emotional mistakes at exactly the wrong moments. Volatility is the price you pay for silver's upside potential. Accept it or avoid the asset entirely. For holders, the current environment suggests patience with vigilance. Supply concerns support the thesis, but nothing moves in straight lines. Expect chop, reversals, and frustrating consolidation. Your job is to maintain the discipline to hold through noise while having the wisdom to recognize when fundamentals genuinely shift. What if you don't own silver but are considering entry? First, abandon the search for perfect timing. You'll never catch the exact bottom. That's not how successful investing works. Instead, focus on whether risk-reward at current levels justifies position building. Ask, if silver falls 20% from here, can I tolerate that financially and emotionally? If yes, current levels may offer entry. If no, either wait for better prices or accept silver isn't right for you now. Second, consider entry strategies that reduce timing risk. Rather than committing capital all at once, scale into the position over weeks or months. This averages your entry price and removes pressure to get it right. For example, allocate the total amount you want in silver. Divide it into 4 or 6 tranches. Enter one tranche now, add another if prices fall, add another if they rise but fundamentals strengthen. This approach ensures you participate without overcommitting too early. Third, clarify your time horizon. Are you investing for 6 months, 3 years, or 10 years? This matters enormously. If your horizon is short, silver's volatility creates significant risk. You might buy at a local peak and face extended drawdowns. Short-term silver investing is really trading. It requires technical skill and active management. If your horizon is long, volatility matters less. You're betting on structural supply-demand imbalance playing out over years. Short-term price swings become noise, not crisis. Most investors should approach silver with multi-year horizons, if approaching it at all. Fourth, size your position appropriately from the start. Don't tiptoe in with a token amount that won't matter if you're right, but don't bet the farm either. A meaningful but not dominant position, perhaps 3 to 7% of portfolio, provides exposure worth caring about without creating undue risk. Fifth, understand what you're buying. If you choose physical silver, research reputable dealers. Understand premiums, shipping, and storage. Beware of collectible or numismatic coins with excessive markups. You want silver content, not overpayment for rarity. If you choose ETFs, understand the structure. Does the fund hold physical metal or derivatives? What are the fees? What is the tracking error versus spot prices? If you choose mining stocks, you're adding company risk, management quality questions, and operational issues. This isn't pure silver exposure. It's equity exposure with silver as a major variable. Finally, integration with the rest of your portfolio matters. How does silver interact with your other holdings? Does it provide genuine diversification? Silver typically exhibits low correlation with stocks and bonds, making it potentially valuable as a portfolio stabilizer, but only if sized appropriately and paired with complementary assets. For potential investors, the current moment offers something valuable: visibility. The supply discussion is public. You're not discovering a secret. But early awareness before widespread recognition creates opportunity. The question isn't whether to invest. The question is whether, at what size, and via what approach, given your specific circumstances. Let's address the behavioral traps that destroy capital, even when investors identify correct fundamental trends. Buying, because you're excited, scared, or caught up in narrative, is a recipe for poor timing. Markets peak when emotion peaks. Your job is to be rational when others aren't. Instead, make decisions based on predetermined criteria, not feelings. Write down why you're investing before you commit capital. If you can't articulate clear logic, don't buy. Using margin, futures, or options to magnify silver exposure dramatically increases risk. Yes, leverage amplifies gains. It also amplifies losses. And in volatile commodities, losses come fast and hard. Countless investors have been right about silver's direction, but wrong about timing, getting stopped out in leverage before the move materialized. Don't let this be you. Instead, size positions based on cash capital you can afford to lose without affecting your financial security or sleep quality. Hoping for the best isn't strategy. Without predetermined exit criteria, both for taking profits and cutting losses, you'll make reactive, emotional decisions at exactly the wrong moments. Instead, before entering, write down, I'll take partial profits if silver reaches X. I'll reduce exposure if it falls to Y. I'll reassess my thesis if these conditions occur. Buying after silver has already rallied significantly because you're experiencing FOMO, fear of missing out, often means entering at local peaks. This timing virtually guarantees you'll face immediate drawdowns that test your resolve. Instead, be willing to miss moves. Better to buy on weakness after excitement fades than chase strength into emotional peaks. Becoming singularly focused on silver, concentrating wealth into a single idea, creates unnecessary fragility. Even when you're right about the theme, concentration means timing, and volatility can still destroy you. Instead, maintain balanced exposure across asset classes. Silver can be important without being everything. YouTube channels, social media, and forums are full of people predicting imminent silver moonshots. Some are well-meaning but deluded. Others profit from your participation, regardless of whether you succeed. Instead, seek out sober analysis from sources that acknowledge uncertainty and risk. Be skeptical of anyone offering guarantees. Buying silver forms that are difficult to sell, rare coins, large bars, illiquid miners, means you can't adjust positions when circumstances change. In crisis, liquidity matters enormously. Instead, prioritize holdings you can sell quickly if needed. Recognize that liquidity is a form of optionality worth paying for. High premiums on physical purchases, management fees on ETFs, and bid-ask spreads all erode returns. Small percentages compound dramatically over time. Instead, minimize costs wherever possible. Shop for competitive premiums. Choose low-cost ETFs if going the fund route. Every dollar saved on costs is a dollar of return preserved. Once invested, seeking only information that supports your position while ignoring contrary data is human nature and destructive. Markets don't care about your position. Your job is to assess reality, not defend your choices. Instead, actively seek arguments against your thesis. Force yourself to articulate why you might be wrong. This intellectual honesty protects capital better than any prediction. Investing in silver while carrying high-interest debt, lacking emergency funds, or neglecting retirement contributions is irrational. Building wealth requires foundation before speculation. Instead, address fundamentals first. Only allocate to silver from capital genuinely available for long-term investment with attendant risk. These mistakes sound obvious in list form. They're not obvious in the heat of market action, when emotion and narrative overwhelm logic. Successful investing is more about avoiding stupid mistakes than making brilliant predictions. Protect yourself from your own behavioral tendencies. Step back from silver specifically. What are we really discussing? We're talking about how to think about uncertainty, how to position for potential regime change in commodity markets, and how to balance conviction with humility. Silver is the case study, but principles apply broadly. In any investment opportunity, you're weighing probability against magnitude. How likely is a particular outcome? If it occurs, how significant are the consequences? High probability, low magnitude situations don't offer much opportunity. Everyone sees them. They're priced in. Low probability, low magnitude situations aren't worth attention. Who cares? High probability, high magnitude situations are rare. When genuine, they're extraordinary opportunities. But be skeptical. If it seems obvious, you're probably missing something. Low probability, high magnitude situations are where asymmetry lives. These are the fat tail scenarios that most investors ignore until too late. Where does silver sit currently? It's not high probability that supply collapse creates crisis, but it's not negligible probability either. And if it occurs, magnitude could be substantial. This is the profile of positions worth considering in modest size. You can be wrong and survive. If you're right, outcomes are meaningful. This framework, thinking in probabilities and magnitudes, applies everywhere. It's how professionals think about risk. It's how you should think too. Another principle, markets are smarter than you. This isn't defeatism, it's realism. Thousands of well-resourced, intelligent people are analyzing the same data you see. If something seems obviously mispriced, question your analysis. Maybe you're early. Maybe you see something others miss, or maybe you're overconfident in incomplete understanding. Humility is an edge. It prevents you from overbetting on ideas that seem certain but aren't. Finally, recognize that wealth builds slowly through compound decisions, not lottery tickets. Even if silver performs extraordinarily, it's one position in one period. Your financial future depends on decades of decisions, discipline, and adaptation. Don't let any single investment, silver included, distort your broader financial life. Keep perspective. The silver market is showing signs of structural tightness. Supply growth has stalled while demand accelerates from both industrial and investment sources. Inventories are declining. The margin for error has narrowed. Does this guarantee explosive price appreciation? No. Markets are complex systems with countless variables. Predictions are hubris, but it suggests the probability distribution has shifted. The chance of significantly higher silver prices over coming years is likely higher than market pricing fully reflects. For disciplined investors, this creates possibility, not certainty. If you hold silver, the current environment validates patience. Supply concerns support your thesis, but maintain discipline around position sizing, exit criteria, and emotional management. Don't let confirmation bias or greed undermine sound strategy. If you're considering silver investment, the current moment offers reasonable entry from a risk-reward perspective, assuming you approach it properly. Scale into positions, size appropriately, clarify time horizon, avoid common behavioral mistakes. If silver doesn't interest you, that's perfectly valid. No investment is mandatory. Opportunity cost is real. Capital deployed to silver is capital unavailable elsewhere. Ensure allocation aligns with comprehensive strategy. Regardless of your specific decision on silver, the principles we've discussed apply universally. Understand market structure. Monitor multiple indicators. Think probabilistically. Manage risk before seeking return. Control emotion. Maintain humility. These principles, applied consistently, build wealth across market cycles and asset classes. The silver supply discussion is significant, but it's not the only thing happening in markets. Maintain broad perspective. Stay informed across domains. Build balanced portfolios that can withstand various outcomes. Financial success isn't about calling one big trade. It's about making sound decisions repeatedly, managing risk continuously, and adapting as conditions evolve. You have the information to think clearly about silver. Now comes the hard part. Translating knowledge into disciplined action aligned with your personal circumstances. Will silver supply concerns materialize into actual shortage? Will prices rise dramatically, moderately, or not at all? We cannot know. We can only position thoughtfully based on available evidence and our assessment of risk-reward. That's not weakness, that's wisdom. Markets reward those who prepare, not those who predict. Build positions that allow you to benefit if you're right, but survive if you're wrong. Stay patient, stay rational, stay disciplined. Regardless of what silver does, next week, next month, or next year, these qualities will serve your financial life far more than any single trade. Thank you for your time and attention. I hope this analysis helps you think more clearly about silver markets and investment decision-making broadly. If this video provided value, please like and share it with others who might benefit. Subscribe to the channel for ongoing analysis that prioritizes clarity over hype, substance over sensation. Subscribe button, red. Until next time, take care of your capital and your judgment. Both require constant attention. Good luck out there.